Wall Street keeps saying it will tokenize trillions. Today, it is tens of billions. Real yield, real assets, and most of it gated so tightly that you cannot get in. I'm Rachel from ChainSense. In the next 9 minutes, what tokenization actually puts on a blockchain, who is really allowed to touch it, and the risk hiding inside the wrapper. I have watched this space go from a curiosity to a product with BlackRock's name on it. The yield is real. The only question that matters is whether it is real for you. Here is the thread running through everything today, so hold on to it. The yield is genuine, but someone else decides whether you are allowed near it. So let me start with what tokenizing a real-world asset actually means. You take something that already exists off-chain, a government bond, a private loan, a bar of gold, and you issue a digital token that represents a claim on it. The token tracks the value of the thing underneath, and it pays you whatever that thing earns. That is all a real-world asset token is, RWA for short, traditional finance, wrapped so it can live and move on a blockchain, around the clock, without the old gatekeepers. It is well past the experiment stage now, a multi-billion-dollar market, with several distinct categories, each worth more than $1 billion on their own. The biggest single category is tokenized government debt, and that is exactly where the access story begins. So why is this suddenly everywhere? Because the institutions arrived in force. BlackRock, Franklin Templeton, and Fidelity all run live tokenized funds today. JP Morgan has filed to join them, and it already supplies the pricing data behind one of Fidelity's. The regulations got clearer, the plumbing got more reliable, and the pitch became very hard to resist. Dollar-denominated yield, paid straight to a wallet with no brokerage account and no market hours. For an institution sitting on idle cash, that is genuinely transformative. Money that used to sleep now earns, every hour of every day. But here is the catch, and it runs through this entire video. Wall Street showing up does not mean Wall Street invited you. The very products making the headlines are, for most people watching this, completely locked. The institutions are already inside the building. The real question, the one nobody puts on the thumbnail, is which door, if any, actually opens for you. Start with the biggest category, tokenized treasuries. Government debt, on a blockchain, paying that 4 to 5% yield. 3 names define it, and they could not differ more in who they let in. BlackRock's BUIDL is the one everyone cites. The institutional benchmark, the brand name fund. It is also walled off behind a $5 million minimum and qualified purchaser status. That is not a fund a normal wallet will ever hold. Franklin Templeton's BENJI is almost the opposite, a registered fund that ordinary Americans can actually buy through an app. And Ondo is the crypto-native route, built deliberately for the people the first 2 shut out. Same treasury yield underneath all 3. 3 completely different doors. I will put them head-to-head later in this cluster, because once you see the access map, which one is best, turns out to be the wrong question entirely. Treasuries are the safe end of the spectrum. The high-yield end is tokenized private credit, real off-chain business loans, packaged into tokens through protocols like Maple, Centrifuge, and Goldfinch. The numbers look spectacular next to treasuries, roughly 8 to 15% against 4 to 5. But that gap is not a free lunch. It is the market pricing real risk. Borrowers who can default, money you cannot pull out on demand, and far less transparency than a government bill. There is a genuine improvement here, and it is honesty. You can see more of what actually backs your yield than you ever could in traditional private credit. But the risk is every bit as real as the return. And like most of this space, the richest deals are fenced off for accredited investors, not for you. Then there is tokenized gold, and here the promise sounds beautifully simple. 1 token, 1 ounce, redeemable for real metal. Pax Gold and Tether Gold lead this corner, each token backed by a physical bar sitting in a vault, and anyone can buy a fraction of one. So this is genuinely the most open part of the whole space, with no accreditation, no $5 million gate, no passport check at the door. But read the redemption clause before you celebrate. To actually take delivery of metal, you typically need a full London bar's worth, hundreds of tokens, a small fortune, plus fees and shipping and paperwork. For almost everyone holding it, this is not gold in your hand. It is a price exposure token with a claim attached. Convenient, liquid, fully backed. But do not mistake it for the bar in a safe. That distinction is the entire second compare video. Now the part most guides skip entirely, and it is the whole point of this video. The barrier, most of the time, is not money. It is your passport. Watch how this actually works. If you are in America, you can hold Franklin Templeton's retail fund. But you are locked out of the big crypto native yield token because of securities law. If you are anywhere else in the world, it flips completely. That crypto native token is open to you, but the American retail fund is not. And the headline products, those $5 million institutional funds, they are for almost nobody. So the next time someone tells you real-world assets are democratizing finance, ask them the only question that actually matters. Democratized for whom? The yield is identical no matter who you are. What changes entirely is whether the door has your name on it. If you watch one video in this cluster, make it that one. One last thing, because the yield being real does not make the package safe. Tokenizing an asset stacks new risks on top of the thing underneath. The smart contract can fail, the custodian can fail, the issuer can be a single point of concentration, and the redemption gate can slam shut at exactly the moment you want your money out. The Treasury bill itself might be as close to risk-free as finance gets. The wrapper around it is not. And keep one line straight, because the whole space blurs it constantly. This is real-world assets on a blockchain. It is not stablecoins. A stablecoin holds its dollar peg through reserves. These pay you yield from something real underneath. The mechanics of Tether and USDC are a completely separate conversation, one for another day. So here is where it leaves us. The technology is real, the yield is real, the institutions are real, and access is gated by accreditation and by geography, with a risk wrapper most pitches quietly skip. Over the next 2 weeks, I am taking each piece apart: treasuries, private credit, how to actually get in from wherever you live, and gold, across 6 deeper videos with the links in the description. Real-world assets aren't democratized. They're tokenized, and that's not the same thing. Subscribe to ChainSense. I'm Rachel. See you in the next one.